Tom Lee just updated his channel with a new video. It's an interview recorded on July 4th, where he shared some very interesting insights on monetary policy, and I felt like it's worth sharing. Tom Lee explained that if U.S. core inflation, the core CPI, were measured the way the ECB, the European Central Bank, calculated it by excluding shelter, it would already be around 1.9% year over year. This is core CPI, as opposed to 3.1% year over year. But I wasn't able to find a chart for core CPI excluding housing, but I was able to find a regular overall CPI. Right? So that year over year in the red line is up 2.73%. The blue line represents overall CPI minus shelter. It's up 2.18%. As you can see, there is a big difference for the overall CPI when you're minusing the shelter component from it. And if we compare the right now, the core US CPI minus shelter, the 1.9, we compare that with the European core inflation, which is calculated using the same method, it will be at 2.3% year over year, meaning that the US core CPI minus shelter is cooler than ECB's core CPI minus shelter. So the European Central Bank's current deposit facility rate, which is policy rate, is at 2.5%, while the Federal Reserve Fed funds rate is at 4.5%. So there is a 2% rate gap because of how housing is treated in the CPI data. So this raised a question: is the Federal Reserve unintentionally or intentionally tightening the policy rate just to punish the U.S. housing market? But of course, the Federal Reserve never frames it that way. Instead, they consistently states that the rate hike are driven by expectations of higher inflation resulted from tariff. On tariff, Tom Lee argued that tariffs are essentially a tax, since the money flowed directly to the government and back into the economy rather than being a true inflation. So for example, Tom Lee said if US imposes a $6 per gallon tax on the gasoline, kind of like the Canadian carbon tax, the CPI would show a higher price. But the Fed wouldn't normally raise rate in response because households are already absorbing that hit, meaning their spending power has been hit. So in fact, the Fed might even cut interest rate, recognizing the drag on the spending power. So Tom Lee believes that no matter where the price increase occurs in the chain, it still functions as a tax, not a genuine inflation. So it doesn't matter if it's an income tax on the income or a tax on the importers. It's the same. It's a tax. So what Tom Lee is saying is that pretty much both income tax or tariff, they act as a tax that reduces consumer spending power through different even though they're at different points of the chain. Income tax lowers dispensable income directly, right? There's less money to spend, while the tariff causes a temporary price increase that indirectly reduces spending power because your money can't buy things you used to be able to buy. The two have the same net effect on the consumers, however, have different effects on other aspects. A tax on the importer, a tariff, helps protect local manufacturers, but it does not reduce a wealth gap or wealth inequality. Well, an income tax helps shrink the wealth gap between the rich and poor, but does not help or protect the domestic producers. So Tom also emphasized that the tariff don't create a lasting inflation because money collected by the government doesn't disappear. It gets recycled back into the economy through government spending, which means that it's eventually going to create more jobs. So in his words, it's essentially a transfer of money rather than a real increase in price across the system. Wharton Business School professor Jeremy Siegel also shared his opinion on Federal Reserve's response on tariff. He stated that tariff acts like a tax on the economy. It's pretty much same as what Tom Lee was saying. And there's no strong economic model that justifies the tightening monetary policy in response to a tax. So if tariff is a tax, you don't just hold the rate high to deal with a tax. The inflation effect on tariff is not a central issue because it's temporary. It's a one-time effect. And he believes the temporary bump on the CPI will be about 1 to 1.5 percentage point. And I believe that this bump does not justify Federal Reserve's tightening. And he said the money supply is currently growing slower than ideal, showing no signs of runaway inflation. And broader indicators show no sustained inflation pressure. So this is the chart of the M2 money supply he mentioned, right? So the year-over-year money supply for June of 2025 is an increase of 4.5%. It's actually similar to the pre-pandemic level. Right? So M2 is actually a very good indicator. It has proven itself during the pandemic. It's a leading indicator to inflation because if you look at this, the year-over-year M2 pretty much peaked in 2021. However, the CPI peaked somewhere in 2022. So it's a good inflation leading indicator. It captures how much money are created in the system through credit. So in Bank of America's latest flow show report for the institutions, Michael Harnett highlighted a chart showing that so far in 2025, there has been 88 central bank rate cuts, right, globally. So it's the fastest easing cycle since the 2020 COVID crash easing cycle. So the blue line is 2020, right? So 2025 so far here is number 2 in terms of how many central bank cuts are out there, suggesting that the Federal Reserve will likely follow the dovish global central bank trend, right? There will be some peer pressure, and there of course will be a lot of political pressure because the politicians are going to point at this data and say, why are you not acting while everybody else is acting on it? In the latest fund manager survey from Bank of America, when asked whether the next Fed chair, which will start working in 2026, replacing Powell, will resort to quantitative easing or yield curve control to help alleviate the U.S. debt burden, 54% of the respondents said yes, while 36% said no. So this highlights that the concern over the U.S. government debt sustainability and suggests that the fund managers, the Wall Street, are expecting a dovish Fed stance going forward, especially in 2026. So this chart shows you the federal government's interest payment in every quarter, and it's in the dollar value. So in Q2 of 2025, they paid $283 billion in interest payment, which is about 100% increase from the pre-pandemic level, which helps explaining why the government pressures the Federal Reserve to cut interest rates so that they can when they issue new debt under lower rate, it's going to be cheaper because they need to constantly issue new debt to service the existing debt. So Michael also believes that this loose monetary policy in the future will likely weaken the dollar, which in turn would be bullish for gold and cryptocurrency. So on the Wall Street, like we have seen that there are a lot of expectations on for a more dovish Fed in the future. While at the corporate level, sentiment is already improving significantly. This chart shows you the number of S&P 500 companies citing the word inflation on their earnings call during the Q2 earnings season, which we just pretty much finished. So the number of companies mentioning the word is down 87% in Q2 compared to Q1, right? So it went down from 124 companies down to 16, right? So when companies, they do earnings call, they look at their earnings result, right? They can feel it. If the economy is bad, their numbers are going to be bad, right? So they talk based on the data. So when there is a big shift in sentiment like this, it just tells us their numbers are doing good. So of course, we did have a strong Q2 earnings season. So the key takeaway is that the corporate America is remaining resilient and has successfully navigated through the impact of tariff, and their sentiment is improving a lot. Thank you. Please like and subscribe.